will build on our leadership in our core European markets, and we will expand in major defined contribution markets with a focus on Northern Europe, such as the UK, Ireland, Germany, and Netherlands. We will also pursue new distribution partnerships across Europe and Asia to unlock new opportunities. And that's all for me. I'm going to hand back over to Vincent now for some closing remarks.
Thank you, Dominique. That's impressive. So in conclusion, retirement represents a massive opportunity for Amundi. We have the experience, we have the breadth of capabilities to grow our footprint and achieve our 100 billion flow target by 2028, so 100 billion. We will leverage our global scale and our local presence to address both institutional and retail segments. So our strategy is well targeted, our plan is clear, and we are ready to execute. Thank you very much.
Thank you, Vincent. Thank you, Dominique. Our next deep dive is about ETF, which, as Valérie said, is an exponentially growing business, especially for us at Amundi. We'll start, like the previous deep dive, with a short video, and then Fanny, Benoît, and Gilles will detail our ambitions for the next 3 years.
Good afternoon. I am Fanny Wirtz, Head of Wealth and Distribution, ETF, and Chair of Asia. I am pleased to be here with Benoît Sorel and Gilles Dauphiné for this deep dive on our booming ETF business. Before we share a roadmap, let me first remind you what has made us successful over the past few years. 3 years ago, when we acquired Lyxor, we announced a 2025 target of 420 billion for the ETF and indexing platform. We are already at 481 billion, reaching this target 1 year ahead of schedule. We have also raised 55 billion of net inflows in the first 9 months of 2025. In ETF, we reached the 300 billion milestone at the end of September. This was achieved thanks to solid commercial performance across all client segments and all geographies. In terms of clients, since our last medium-term plan, we have intensified our client diversification with roughly half of our AUM from retail at large, and the other half from asset owners and asset managers. For digital channel, we have achieved major growth, multiplying our AUM by 4. In terms of geographies, in Europe, we were already well diversified and have further accelerated in Germany and the UK. German clients now represent close to 1/4 of our AUM. Outside of Europe, we have more than doubled our AUM over the last 3 years. And for all of these reasons, we are very confident about the future. Let me hand over to Benoît, who will share more details about our ETF platform, and I will be back at the end to cover our key growth drivers for the coming years.
Well, thank you, Fanny, and good afternoon, everyone. My name is Benoît Sorel, and I'm heading Amundi's ETF and indexing business line. Let me start with a few words on our cutting-edge platform and the growing scale of our business. We've highlighted here a few data points to illustrate our progress. If we look at the platform's AUM that Fanny just mentioned, relative to the number of staff, for instance, we now manage 5 billion euros per full-time employee. This figure was 3 billion just 3 years ago. This is a 67% increase. We offer the full choice in replication techniques, physical, synthetics, hybrids, the full range of fund domiciles from Ireland to Luxembourg, France, and Germany, and the full range of investment wrappers, ETFs, index funds, mandates. This is powered by a fantastic industry-leading technology with dedicated Alto modules. This includes Alto index tracking to industrialize equity and fixed income index investment processes, and a dedicated web portal to process ETF orders from authorized participants called Alto AP. Being an efficient ETF provider also means operating in an efficient ecosystem. For instance, in terms of liquidity and market access, we have over 120 billion euros in annual exchange-traded volumes on our ETFs. And the last word on the scale of our platform versus our peers. We have doubled our share of billionaire ETFs in the market with 79 ETFs over €1 billion. This is also a key element of scale and liquidity for our clients. So now beyond scale, another key reason for our success is innovation. We've been at the forefront of ETF indexing innovation from the very start, driven by client centricity and business pragmatism. Let me share a few examples here again. Since our last strategic plan, our innovation has focused on 3 key trends. First, championing responsible investment and climate adoption amongst institutional investors. 2 great examples are the Bespoke Low Carbon Fund we launched back in 2020 in partnership with Oxford and Cambridge universities. And more recently, the ETF we co-designed with FLAR, which is a reserve fund from Latin American central banks. Second, providing more precise building blocks for asset allocators, which is central for the ETF industry. A great example here is the dual launch of our US Megacap and ex-Megacap ETF, which is now a key element for more refined US exposure, or our European Defense ETF. Third, a key driver for innovation has been to address retailization. Retail adoption is a major growth driver in the ETF market, and we're at the forefront of translating this trend into product innovation. Our lifecycle ETFs that fit into goal-based or retirement investing are a perfect example. These are great tools for a new retirement business, which Vincent and Dominique just presented earlier. As you can see, all these innovations arise from close relationships with our clients and commercial partners. Looking ahead, we have already a very strong pipeline for the coming 12 months, and we plan to launch around 50 new ETFs over the next 3 years, always with our guiding principle of client centricity. Let me now hand over to Gilles, who will zoom in some of the rising needs in the ETF market.
Thank you, Benoît. So good afternoon, everybody. I am Gilles Dauphiné, the head of the Active and White Label business line. Let me start with Active ETF. Over the past 18 months, AUM of Active ETF in Europe have doubled, and they are expected to triple by 2029. This is an exciting opportunity, as Active ETF generates much higher fees than index ones. Amundi has been an early mover in launching Active ETF with a full SRI label ETF suite. By combining our first-class ETF capabilities with our undisputable active expertise through our 17 investment centers, we can offer clients the best of both worlds. Today, we are going one step further in Active ETF by launching a dedicated business line and building a full range of Active ETF. I am pleased to confirm that the Amundi Euro Money Market ETF will be launched and listed on the exchanges in the coming days. Our Active ETF will cover all critical building blocks for clients wishing to create a diversified portfolio, from money market to credit, from credit to equity, using fundamental strategies on equity. They will encompass a wide range of geographical exposures, including global, US, Europe, emerging market. And to meet the growing demand from wealth managers and digital platforms, we will add a full Active ETF model portfolio to our offering. In total, we are planning to launch 20 new Active ETF by 2028. Now, as the largest European ETF provider, we are also the best positioned player to offer what we call ETF as a service. This is a white label or ETF hosting proposition, which allows our client to benefit from a highly scalable ETF infrastructure, but under their own brand. The demand from this service is coming mainly from 2 client segments. On one side, digital and wealth partners looking to develop an ETF offering under their own branding. On the other, asset managers wanting to unlock the benefit of ETF wrappers for their own active strategies, and thus without having to launch their own platform, which can be costly. Backed by our first-class scalable platform, we are becoming the one-stop shop for all clients embracing the ETF journey. Our offer is modular. We are able to cover all or just some parts of the ETF value chain. This means we are perfectly adapting to client needs. We already have multiple client successes and a very strong client pipeline. We have highlighted 2 recent ETF as a service wins in Germany, one with digital investment platform Finanzen.net, and another with asset manager Leikon AG. By offering this service, we are diversifying our revenue streams while leveraging on our existing platform, and we are broadening our set of services and solutions to serve our client end-to-end. By 2028, we plan to launch 30 new ETF under this service. Back to you, Fanny.
Thank you, Gilles. And let's look at our key drivers for the coming years. The retail ETF market is booming across the globe. In Europe, for example, the number of self-care investors already stands at 31 million and is expected to almost double in the next 3 years. Germany will lead the way with 10 million digital investors. The UK will follow very closely behind with a projected 9 million investors, while France, Italy, and Spain will double the number of digital investors. At Amundi, we are fully embracing this opportunity. We have grown twice as fast as the market, and we have no more than 45 digital wealth partners, like Revolut and BoursoBank in Europe, and Dois in Asia. But we are also expanding to new territories, like South Africa, where we just signed a partnership with Satrix. In the coming years, our objective is to partner with all key digital players in every major market, increasing the number of partnerships by 50%. We also leverage this strong positioning and know-how to be the partner of choice for leading banks and wealth managers digitalizing their offering. This obviously goes beyond ETF, as we are equipping our clients with our full suite of Amundi solutions, including portfolio models and wealth tech. So, we just have seen how the retail segment is accelerating its adoption of ETF, but the same can be said from asset owner. These investors are using our over 300 off-the-shelf ETF. But beyond that, let me show you 3 examples of how we address and leverage as well their specific needs. First, central banks. Central banks are increasingly adopting ETFs to meet specific needs. And ETFs now constitute a large part of their reserves. As an example is FLAR, the Latin American Reserve Fund that was mentioned earlier by Benoit. Here we have co-designed a global ESG corporate ETF where 4 Latin American central banks and supranationals have already invested. Second example is pension funds. One of our clients, Ilmarinen, requested a bespoke climate ETF solution, which we were very happy to launch for them. And third, retirement and defined contribution. As highlighted by Vincent and Dominique earlier, we are working with the People's Pension, who have trusted Amundi with a £20 billion index mandate coupled with technology and ESG advisory. These are only 3 examples, but we have many more. They are good illustration of how we can partner with institutional clients on their ETF and indexing need. And we obviously have room to grow. Over the next 3 years, we target to increase the number of institutional clients equipped with ETF and index by 50%, leveraging Amundi's very robust institutional sales force. Today, we have given you a quick tour of how Amundi is leading the exponential growth of ETF markets. Over the coming years, we will widen this leadership as being the partner of choice for every ETF and indexing need. We will champion the massive retail and digital wealth opportunity, increasing our number of partnerships by 50%. We will further equip central banks and institutions with bespoke ETF and index solutions, increasing the number of ETF-equipped institutional clients by 50% as well. To do so, we will pursue our client-centric innovative trajectory, addressing all of the high potential themes. We will leverage our first-class platform to deploy ETF as a service. We will expand the reach of our active strategy through the launch of a full suite of active ETF. By 2028, we will have launched a total of 100 new ETF, widening our leadership as the number one ETF provider. Thank you for your attention.
Thank you, Fanny, Benoît, Gilles. Our next deep dive is about technology. As you know, technology is a new business for Amundi since 2021. Guillaume and Ben will present the way forward for the next 3 years. But before, we will start with a video looking at the tech opportunity.
Over the last 25 years, technology has reshaped every aspect of the business world. And the pace of innovation is only accelerating. And yet, many parts of financial services are still catching up. But with margins getting squeezed, and technology costs rising due to outdated and fragmented technology stacks, the industry is realizing that transformation is no longer optional. The industry is now focusing on modernizing their technology and data infrastructure, putting it at the heart of their strategic priorities. And many of them admit that they cannot do it alone. Amundi Technology is positioned to lead as the partner of choice. We combine deep industry expertise with scalable technology to deliver excellence for our clients through our Alto suite of solutions. Over the past 3 years, our client base has rapidly grown and diversified across market segments and geographies, creating a solid foundation for growth.
Good afternoon. For those who don't know me, I am Guillaume Lesage, Group Chief Operating Officer of Amundi. 1903. In 1903, King Edward VII arrived at Gare du Nord in what would be a key step in establishing the Entente Cordiale between the UK and France. I'm happy today to be presented in partnership with Ben Lucas, the CEO of Amundi Technology, and a loyal British subject of His Majesty, to continue this tradition. We created Amundi Technology just 4 years ago, and it is already a key growth driver and a strategic enabler for the group. Thanks to the progress made since then, we are now a fully fledged tech provider with a recognized software as a service, SaaS, solution that covers the entire savings value chain. Alto is now one of the most innovative solutions on the market, a must-have in the tech world. It is modular, it is open source, and it is enhanced by artificial intelligence. It has also become a key strategic enabler for the wider Amundi Group. Why? Because it enhances the investment solution Amundi provides to its clients. Because it creates durable long-term relationship. And because it represents a key differentiator compared to most asset managers. We have secured some fantastic strategic client wins in recent years, and we spoke about several of these at the third-party distribution workshop organized earlier this year in London. You'll be aware of Amundi's 20 billion investment mandate with the People's Pension. Fanny spoke about it. In addition to this mandate, we offer TPP access to a comprehensive suite of services and solutions, ESG data, metrics, reporting, data analytics, all delivered through Alto. Second example, a wealth institution delegates billions of funds to Amundi and at the same time has chosen Alto to manage its own direct investments and oversee the global risk and performance of its assets. What I would like to highlight is that all technology partnerships are strategic, with decisions made at a CEO or at a COO level. And they are long-term, lasting at least 5 years, very often 10 years. As mentioned in the video, we have created a solid foundation for growth, tripling where we were at the start of the last plan. Our client base is now very international, with clients in more than 15 countries, and we host 8 trillion euros of assets on the platform. We have invested both to develop and improve the Alto platform with the 4 core solutions, but also to transform our organization from a top IT department to a true software company. The acquisition of Exigo, leading wealth tech, has enabled us to accelerate our penetration in a market which is massive. Exigo provides an API-based solution. API means application programming interface that can be easily integrated into the IT systems of banks. And I can tell you this integration capacity is now becoming a standard requirement for large firms like Commerzbank or Vontobel. Finally, the integration of Exigo into Amundi technology, thanks Ben, is now fully completed, and the feedback from Amundi clients is very, very positive. Let me spend now a moment on Amundi's product and geographic diversification. You can see on the left of the slides that revenues are well diversified between the 4 products. First, Alto Investment, which is used by Amundi for our business, is our first offer and represents about a third of revenues. It has been joined by Alto Employee Saving and Retirement, dedicated to French clients, another third. And then Alto Wealth and Distribution, which focuses on advisory and DPM, discretionary portfolio management, for retail and wealth banks. And Alto Asset Servicing, which covers compliance control, portfolio analysis, report generation. Those 2 together make up the final third of revenues. Ben will go into more detail on new offerings, AI, data management, that we will roll out in the coming years. But it is clear that this product diversification allows us to benefit from clients' different investment cycles. It also allows us to benefit from cross-selling to existing clients. For instance, one of our major insurance clients, they use Alto Investment to monitor their portfolios, and they chose Alto Employee Savings and Retirement for another business for their corporate clients in collective insurance. On the right, you see we are also increasingly diversified by geography. You can see that our clients are well spread across almost all European countries, and we are progressively expanding into Asia. As investors, you know that fintechs have very often difficulties to expand beyond their initial market. We have proved our capacity to do so because we built a global solution from day one. And now, let me hand over to Ben to look more closely at our plan for the next years.
Thank you very much, Guillaume. Appreciated. I'm delighted to share with you our clear roadmap to make Amundi technology the preferred solution for the savings and investment ecosystem across Europe and Asia, and ultimately to double our revenues. There are 3 pillars to our plan. First, we will continue to expand our product suite, launching new offerings that meet the evolving demands of the market. Most notably, as Guillaume mentioned, data as a service and Auto AI Studio. Second, we will leverage our acquisition of Exeger to capture the significant and fast-growing opportunity within the wealth management segment. And third, we will fully leverage the power of the Amundi Group by unlocking distribution synergies and offering integrated investment and technology solutions. Each pillar supports our goal to materially accelerate our growth and be a leading provider of technology to the industry. So let's take a look at each one. So we are rolling out 2 new strategic products that will support the growth in the coming years. Firstly, financial services is fundamentally a data business. And as we accelerate into a hyper-digital world, how companies use that data and derive value from that data will become even more important. In a recent study by a leading financial institution, data and analytics was identified as the top trend and the focus area for wealth and asset managers in the next 3 to 5 years. Despite this, many players admit it is an area of underinvestment and that poor data quality is a real pain point for them. 60% of wealth and asset managers say they lack the appropriate technology infrastructure. What an incredible opportunity for us. This is why we've developed our data as a service offering, an outsourced service where we manage all the data activity on behalf of our clients, leveraging our robust data architecture, our data provider connectivity, and our market data expertise. It enables our clients to generate actionable insights and make data-driven decisions at a lower cost. The solution is comprehensive, scalable, and is compliant with regulatory standards across markets. And I'm delighted to share that we have recently won our first data as a service client, a leading global insurer in Asia, validating our product market fit. Another undeniable force shaping the future of the industry is artificial intelligence. 80% of wealth and asset managers see disruptive technologies such as AI as a key driver of their growth. However, in a highly regulated industry, the adoption of AI needs to be done with care and with caution. And that is exactly what our solution, Auto AI Studio, delivers. It is our one-stop agentic AI and big data platform. It is LLM agnostic, secure, and has data models that are pre-configured for the asset management industry. And in practical terms, it provides access to Gen AI capability like ChatGPT and Mistral, but in a ring-fenced, secure environment within the client's own organization so that their proprietary data is protected. It also includes AI-powered coding tools, an agentic AI capability with agent orchestration enabled, allowing users to create their own agents. And it's capable of handling large volumes of structured and unstructured public and internal proprietary data. The solution has been developed and tested within Amundi for over 2 years, and all of our 5,600 Amundi employees now have access to it. To give you an example, our compliance assistant uses AI to perform all of the first-level checks on marketing documents for compliance errors. So it results in a streamlined process, but this has significantly reduced the number of irregularities that ever reach the second level of legal and compliance verification. And we've increased the volume of documents that we can check. And now we are ready to offer Auto AI Studio to the market. I'm pleased to confirm that we are already in the final stage of negotiations with a client in Europe to provide it to them. Our second pillar is leveraging our acquisition of Exeger to maximize the significant opportunity within the wealth management segment, which is predicted to double in size by 2030. Banks and wealth managers are facing challenges from all angles. Advancements in technology have increased the expectations from digital channels and at the same time created new competitors completely. These firms need to balance serving the clients that they have with building a model fit for the future against the backdrop of a heavily regulated environment. Many firms, particularly in advisory, feel behind the curve on technology adoption, and they're seeking flexible and scalable solutions. These solutions must be modular, end-to-end platforms that deliver efficiency but support top-line growth. Amundi Technology is well positioned to respond to this demand and to capture the opportunity. Our acquisition of a leading wealth tech company, Exago, last year enabled us to really accelerate the development of our wealth business. We've brought together our complementary platforms to create a broader, more flexible and scalable offering built on the modular first, as Guillaume said earlier, the API first wealth stack that you talked about, that we can tailor to our clients' needs. And we integrated a highly experienced team across development, professional services, sales, who all share our core focus on innovation. So now we have more than 250 experts across the wealth management value chain. And we've strengthened our customer and geographical coverage, penetrating German-speaking markets and acquiring a tier 1 client base. Combining this technology with Amundi's investment expertise, global reach, creates a unique proposition in the wealth space, one that can scale across Europe and Asia and capture the market share as the demand grows. Our third pillar is about better harnessing group synergies. Being part of the Amundi Group is an unparalleled strength and a competitive advantage, first in what we can offer to our clients, but also in our network and our reach. Our first differentiator is our market-leading investment expertise. This knowledge drives our technology roadmap, and it allows us to bring together leading investment expertise with cutting-edge technology solutions. We're seeing increased demand from clients for bundled solutions, and over the last few years we've demonstrated our success in offering our technology platforms alongside our core investment solutions. And a great example of that is we've just been selected by a Nordic client who wanted one single strategic partner covering both investment services and wealth technology. And we are combining our technology with our business services, and I'm delighted to share that last week we also signed a contract for auto investment and integrated data management services with Kempen van Lanschot, one of the oldest financial institutions in the Netherlands, founded in 1737. Yeah. And we can bring all of these together, all three, as we did for a large French player who selected us last year to provide investment services, middle office, and of course, auto investment. Our second differentiator, the power and reach of the Amundi Group. Amundi is present in 35 countries, over 1,600 clients. This gives us clear advantages that we will continue to build on, including an established global distribution ecosystem that most of our technology peers would take years to build or simply would never be able to create. Local market knowledge and experience, meaning we can deliver technology solutions that meet specific local market needs and regulations. And we have a globally recognized and trusted brand as Europe's largest asset manager and a major player in Asia. Bringing these two differentiators together gives us an edge that I am confident will help us to deliver our plan over the next 3 years and double our revenues. So that's all from me. Back to Guillaume for the closing remarks.
Thank you, Ben. Thank you. So Ben, it's entente cordiale. So would you allow me to come back to French accent?
Please.
Thank you. Thank you. It's more comfortable for me. Sorry, guys. So to summarize, Amundi Technology is a major differentiator in our industry, a true tech offer with inbuilt asset management DNA. Our native SaaS solution has proven itself to be solid, to be secure, to be innovative. And we have the capacity to combine technology with service à la carte. And finally, our tech solutions are built on a powerful European infrastructure. Over the past 4 years, we have established Amundi technology in the market. And more importantly, we have built a machine designed for scale. Our strong investment in AI since 2023, our experience in data management have enabled us to design AI and data solutions that will provide even more opportunities. I am convinced Amundi technology will be the preferred solution for the savings and investment ecosystem across Europe and Asia. Be a strong growth engine for Amundi and will, as Valérie said, double revenues by 2028. Enable us to build durable solutions for Amundi clients and keep us at the top of the industry. Thank you very much.
Thank you, Guillaume and Ben, for this exciting entente cordiale. I'm told that we are right on schedule, almost to the second, which in a way is a small illustration of Amundi technology, and definitely a great achievement from our very great colleagues from the corporate communication team. It's now time to take a break. We will have about 15 minutes, and for those online, we will run a video, well, different videos, in fact. They are not actually part of a presentation, but they are obviously interesting, so you can have a look at them, and you will have a countdown that will tell you when the meeting will resume. But in the meantime, let's take a break.
It's been 10 years since our IPO. 10 years of leadership. Years of growth. 10 years of diversification in all geographies. In all investment solutions. Thought leadership. Investment. Technology, services, for all client segments. "10 years of performance for our clients. Years of track record in M&A. 10 years of delivering for shareholders. And 10 years of being a trusted partner. Working every day in the interest of our clients and society.
Trust does not come easily. It is earned. Not through words, not through promises, but through actions. Being a trusted partner, acting every day in your interest and that of society, this has been our raison d'être. In 2010, you were seeking strong new partners you could trust to manage your investments. Amundi, with its roots in Europe, was created with the ambition of becoming a top 10 global asset manager in order to serve your needs. Because you deserve a partner that is able to best serve your investment requirements, Amundi has developed its business over several continents with 6 international investment hubs and offices in 35 countries. Because your expectations are unique, Amundi is constantly developing its asset management capabilities to offer you the investment solutions that suit your needs. Because your investments shape the world and the future, Amundi has made responsible investment one of its founding pillars. Together, we have a major role to play in financing the energy transition. Because our world is ever more digital, your needs are constantly changing. Amundi provides you with innovative services and technology solutions to cover the entire investment value chain and optimize your user experience. Because earning your trust also means helping you to understand the challenges and major trends of tomorrow, at Amundi, we share our vision of the future with you to anticipate and seize the best investment opportunities together. Each day, our 5,500 employees contribute to making Amundi one of the world's leading asset managers to serve your investment needs.
It's been 10 years since our IPO. 10 years of leadership. Years of growth. Years of diversification in all geographies. In all investment solutions. Thought leadership. Investment. Technology. Services. For all client segments. "10 years of performance for our clients. Years of track record in M&A. 10 years of delivering for shareholders.
Trust does not come easily. It is earned. Not through words, not through promises, but through actions. Being a trusted partner, acting every day in your interest and that of society, this has been our raison d'être. In 2010, you were seeking strong new partners you could trust to manage your investments. Amundi, with its roots in Europe, was created with the ambition of becoming a top 10 global asset manager in order to serve your needs. Because you deserve a partner that is able to best serve your investment requirements, Amundi has developed its business over several continents with 6 international investment hubs and offices in 35 countries. Because your expectations are unique, Amundi is constantly developing its asset management capabilities to offer you the investment solutions that suit your needs. Because your investments shape the world and the future, Amundi has made responsible investment one of its founding pillars. Together, we have a major role to play in financing the energy transition. Because our world is ever more digital, your needs are constantly changing. Amundi provides you with innovative services and technology solutions to cover the entire investment value chain and optimize your user experience. Because earning your trust also means helping you to understand the challenges and major trends of tomorrow, at Amundi, we share our vision of the future with you to anticipate and seize the best investment opportunities together. Each day, our 5,500 employees contribute to making Amundi one of the world's leading asset managers to serve your investment needs.
It's been 10 years since our IPO. 10 years of leadership. Years of growth. 10 years of diversification in all geographies. In all investment solutions. Thought leadership. Investment. Technology, services, for all client segments. "10 years of performance for our clients. 10 years of track record in M&A. 10 years of delivering for shareholders. And 10 years of being a trusted partner, working every day in the interest of our clients and society.
Trust does not come easily. It is earned. Not through words, not through promises, but through actions. Being a trusted partner, acting every day in your interest and that of society, this has been our raison d'être. In 2010, you were seeking strong new partners you could trust to manage your investments. Amundi, with its roots in Europe, was created with the ambition of becoming a top 10 global asset manager in order to serve your needs. Because you deserve a partner that is able to best serve your investment requirements, Amundi has developed its business over several continents with 6 international investment hubs and offices in 35 countries. Because your expectations are unique, Amundi is constantly developing its asset management capabilities to offer you the investment solutions that suit your needs. Because your investments shape the world and the future, Amundi has made responsible investment one of its founding pillars. Together, we have a major role to play in financing the energy transition. Because our world is ever more digital, your needs are constantly changing. Amundi provides you with innovative services and technology solutions to cover the entire investment value chain and optimize your user experience. Because earning your trust also means helping you to understand the challenges and major trends of tomorrow. At Amundi, we share our vision of the future with you to anticipate and seize the best investment opportunities together. Each day, our 5,500 employees contribute to making Amundi one of the world's leading asset managers to serve your investment needs.
It's been 10 years since our IPO. 10 years of leadership. Years of growth. Years of diversification in all geographies. In all investment solutions. Thought leadership. Investment. Technology. Services. For all client segments. "10 years of performance for our clients. Years of track record in M&A. 10 years of delivering for shareholders. And 10 years of being a trusted partner. Working every day in the interest of our clients and society.
Trust does not come easily. It is earned, not through words, not through promises, but through actions. Being a trusted partner, acting every day in your interest and that of society, this has been our raison d'être. In 2010, you were seeking strong new partners you could trust to manage your investments. Amundi, with its roots in Europe, was created with the ambition of becoming a top 10 global asset manager in order to serve your needs. Because you deserve a partner that is able to best serve your investment requirements, Amundi has developed its business over several continents with 6 international investment hubs and offices in 35 countries. Because your expectations are unique, Amundi is constantly developing its asset management capabilities to offer you the investment solutions that suit your needs. Because your investments shape the world and the future, Amundi has made responsible investment one of its founding pillars. Together, we have a major role to play in financing the energy transition. Because our world is ever more digital, your needs are constantly changing. Amundi provides you with innovative services and technology solutions to cover the entire investment value chain and optimize your user experience. Because earning your trust also means helping you to understand the challenges and major trends of tomorrow. At Amundi, we share our vision of the future with you to anticipate and seize the best investment opportunities together. Each day, our 5,500 employees contribute to making Amundi one of the world's leading asset managers to serve your investment needs.
It's been 10 years since our IPO. 10 years of leadership. Years of growth. Years of diversification in all geographies. In all investment solutions. Thought leadership. Investment. Technology. Services. For all client segments. "10 years of performance for our clients."
Welcome back. And now the moment that you've all been waiting for. Nicolas Calcoen, our Deputy CEO, will detail our financial targets and go through the financial trajectory that we're expecting for the next 3 years. He will be followed directly by Valérie for concluding remarks. Nicolas, the floor is yours.
Thank you, Cyril, and welcome back to all of you. You've heard from Valérie about our Invest for the Future strategy on how it will drive growth and long-term industry leadership. And you've heard from our business leaders on some of our strategic ambitions. Valérie also shared our key financial targets. As a reminder, these were an adjusted EPS of more than €7 in 2028, a cost-income ratio of below 56% in 2028, and a dividend payout ratio of more than 65% across the plan. You also heard our key capital management principles, built on a continued focus on value-creating external growth opportunities. My presentation today will focus on unpacking each of these in a bit more detail. Before I do, let me outline the main assumptions behind our targets. Consistent with all previous strategic plans, these targets do not take into account any positive market effect. In fact, they are built with a neutral market and foreign exchange assumptions. But we have updated our key sensitivities to market conditions, including foreign exchange, as listed on the slide. The other key point is that we will deliver our financial trajectory in all potential UniCredit scenarios. As announced at Q3, this target reflects the uncertain contribution from this agreement from mid-27 onwards when it comes to maturity. We remain, of course, fully committed to serving their clients with the same high standard and are ready to create value for all parties beyond 2027. But we do not know if it will be renewed under what conditions. If you look at our past trajectory, Amundi has consistently delivered average EPS growth of more than 5% per year from our highly diversified sources of revenue. We are fully confident in our ability to return to these levels. With this in mind, let's take a closer look at our financial trajectory, starting with our 28 adjusted EPS target of more than €7. This target is above 2024 levels and reflects our confidence to more than compensate for any credit outcome. This resilience comes from our growing diversification in terms of clients, expertise, and geographies, combined with our market-leading cost efficiency. This results in lower volatility and higher predictability of earnings. We will deliver strong and sustained underlying growth of 5% from our other business lines. This underlying growth will be demonstrated by the more than 300 billion in net inflows across our strategic priorities. And it will be supported by higher technology and service revenues, which represent additional income less sensitive to market factors. We will complement this underlying growth with other levers, such as the positive effect of our strategic partnership with ICG. This will include, of course, the revenue synergies that will grow over time, and also the equity-accounted contribution from our stake. You should bear in mind that we will progressively build this stake over the next year or so. Therefore, you should not expect this contribution to be booked before the second half of 2026, with a full-year effect only in 2027. Overall, the partnership will deliver an EPS accretion of around 5% over the plan. And the share buyback we have announced today will also deliver a positive benefit on the EPS. Moving to the cost-income ratio next, where we are committing to be below 56% in 2028. This means a continued commitment to industry-leading levels and reflects our continued and robust cost control. Excluding UniCredit revenues, we will deliver a positive jaws effect, meaning revenue growth will be above cost growth. This target also reflects a commitment to significant investment in future growth beyond 28, reinforcing our leadership vis-à-vis key industry trends. This is indeed the most effective way to return to historic levels of growth in the future. We will support our cost-income ratio by accelerating the optimization of our operating model. First, we are streamlining our organization. This includes the plans launched in the second quarter, which will deliver 40 million euros in annual savings from 2026 onwards. A key project was the merger of our CPR and BFT affiliates, which has been successfully completed in just a few months. Another example is the simplification of our European multi-asset setup. Thanks to this, we can respond more efficiently to evolving client needs and best leverage it for our new retirement business line. This plan is just the start of what we can achieve, and there are several other opportunities we can activate. Next, we will optimize our processes to improve our cost base and deliver greater client value. Here, we will take full advantage of the latest technologies, including, of course, artificial intelligence. As Ben explained, we have successfully developed Alto Studio, our fully secure Gen AI platform, which is now 101% available to our teams. 20 AI applications have already been rolled out to date, accelerating delivery across multiple areas such as RFP answering, marketing material compliance review, and IT development. Going forward, AI will allow us to optimize our processes while creating real client value and reducing external spend. By 2028, we will scale 50 AI applications, including expanded agent capabilities across areas like content development, research, or client management. And thanks to these major efficiency gains, we can redirect significant resources to our strategic growth priorities. This will include shifting 10% of our total workforce to these areas. This will also mean investing a total of 800 million euros, an increase of 30% on the previous plan. Around 40% of our investment will be directed to technology. This will allow us to grow our Alto offer for Amundi and for our clients. 60% will then be aimed at our other growth priorities with a focus on talent and enhancing our marketing activities. This means clients, accelerating diversification in retirement and digital distribution. This means geographies, supporting our major Asian growth engine, our expansion in Northern Europe, and our reinforced presence in high-potential regions. And this means solutions, including investment in our industry-leading ETF platform. All of these factors will reinforce our strong positioning and our financial trajectory to 28 and beyond. Moving now to shareholder returns. Under our Strategic Ambitions 25 plan, we committed on a payout ratio of more than 65%, which we have successfully delivered. We have indeed returned around 200 million euros to shareholders through additional dividends above this target. We also committed to use our excess capital for value-creating acquisitions or to return it to shareholders. We deployed around 500 million euros on two external growth opportunities, Alpha Associates and Exigo. As a reminder, the Victory transaction did not consume any capital. On top of that, our new strategic partnership with ICG will strengthen our private asset offer and create shareholder value. As this transaction involves the purchase of around 10% stake on the market, the exact transaction value is yet to be determined. But this will anyway leave some surplus, and as confirmed, we will return this excess capital to shareholders by share buyback. And I can confirm that the total figure will be above 300 million euros. We will provide more information when we announce our full year results in February. Going forward, we will maintain this attractive dividend policy of a payout ratio of 60% or above under a new plan. And we will, once again, prioritize external growth opportunities when it comes to using excess capital. Our strategic priorities for M&A remain the same. This means distribution and client-based acquisition, expertise reinforcement, and technology and services. We will consider all types of deals, majority, minority, joint ventures, when we find the right opportunities that meet our strict criteria. This means transactions that present manageable execution risk, are earning accretive, and provide a return on investment of at least 10% within 3 years. We will therefore maintain an appropriate level of capital for opportunities, and we retain the flexibility to return excess to shareholders. In conclusion, the 2028 target we are presenting today demonstrates the resilience of our business model. This resilience comes from our growing diversification in terms of clients, expertise, and geographies. We will deliver strong underlying growth with more than 300 billion in net inflows across our strategic priorities and the doubling of our technology revenues. We maintain our commitment to market-leading cost efficiency, reflecting our continued and robust cost control. And we will achieve this while investing in the future and delivering, once again, attractive shareholders' returns. That's all for me, and let me hand back to Valérie for some closing remarks before we start the Q&A. Thank you very much.
Thank you, Nicolas. In conclusion, our Invest for the Future 2028 plan will drive growth and value creation in the next 3 years, as well as our long-term leadership beyond 2028. Our commitment is to deliver, yet again, a clear earnings trajectory, industry-leading cost efficiency, attractive shareholder returns, and a defined capital management strategy. And our confidence to achieve this comes from the fact that we are the European, sustainable, and tech-savvy global leader. Thank you very much for your attention.
Thank you, Nicolas. Thank you, Valérie. So it's now time to open our Q&A session. We will obviously take questions from the room as well as online. Again, please raise your hand if you want to ask a question. There will be hostesses that will just hand you a mic here. And if you are online, please also raise your hand virtually, and I will open your mic in due course. We'll start with questions from the room. Difficult to know who to start with. Let's start with Jacques-Henri.
That's great. Thanks a lot. Cyril, thank you. It was a lot of fun. 3 questions from me, please. The first one on technology. After the first plan, the idea was to go to 125 million of revenues. You didn't quite get there, close to 95. Is the fact that you're extending the product and the distribution a little bit what makes you confident you'll get to the double revenue? And are you confident that with that now, this extension of the business, you'll actually get there and fit that? The second question is on the excess capital. How to calculate it? Is it still on the base of a CET1 requirement? Just for us to have a look. And you're mentioning flexibility about it. Are you going to revisit it, for example, every year? Or is it more like an end of the plan, we see what's left, and then we address it? And lastly, I can't resist, as a binational, there's a lot of Brits in the management. That was actually a lot of fun. And you are actually fitting the UK market quite a bit with the agreement with ICG. I was almost about to ask the British members, how is it to work with the French? And that's the last question. Thank you.
Good, thank you, Jacques-Henri. Well, on technology, in our previous plan, we had several targets, a lot of them actually. As you could see, a number of them, we achieved them 1 year in advance. Some of them were not completely at target in 2025. What is really important for me is the trend. And we built, I'm sure that you saw it by listening to Guillaume and Ben, we built a very strong technology company now, which is credible, with a wide number of clients, more importantly, in a large number of countries, because each new country is complicated to open. So we are now much more experienced than when we were 4 years ago, and I am fully confident that the team will reach the targets for 2028.
Regarding excess capital, so indeed our capital position and the excess capital position is calculated by comparison with the regulatory requirement. As you know very well, we are regulated as a credit institution, so it's calculated as based on the solvency requirement.
As you know as well, our business doesn't consume much capital for organic growth, so the position in capital will be progressively rebuilt, and it will be used as a priority for M&A, because we are confident that there will be many opportunities, and we have the capacity to capture that, but we don't want to accumulate capital, so we keep this flexibility to return it if we don't see M&A opportunities at the horizon. And the third
There was a
question.
third question.
The third question is not for me, obviously.
I don't know whether Ben wants to.
Ben, how is it to work with French people? It was a joke, but I think it's important that you answer.
Yes, you did. But it was not that much of a joke.
And Dominic actually can answer as well, even if he's more
slightly on the spot now. But a few things. So when I joined, my deputy, who is very, very French, very strong technologist, he said to me, I like to work hard and I like to have fun. And I thought, okay, I'm going to get along here. And it's been the warmest, welcoming place that I've ever experienced. But I will say, I've had to learn a lot more about British and French history than I ever anticipated, as you saw at the start of the presentation. But on a serious note, it's warm and welcoming and a lot of fun. But we work hard. So.
Entente cordiale again. Question from Hubert from Bank of America. Oh, no, sorry. Nick has the mic. So Nick Herman from Citigroup. And you're next, Hubert.
Thank you. It's Nicholas Herman from Citi. 3 questions, if I may, please. If I look at consensus expectations for earnings this year, then your €7 earnings per share target implies a compound EPS growth between 25 and 28 of 3%. But I guess if we exclude, I guess what you're trying to suggest is though that you have market effects. Maybe there's some upside to buybacks as well. So I guess therefore that should be higher than 3%. And I guess the question I'm really trying to get at here is, excluding, if you were to take out UniCredit, what is the earnings per share growth that your targets are suggesting, and the ongoing net flow rate of the business, please? The second question, just coming back to capital return. So I think you had about 1.3 billion of surplus capital. Maybe it will be 1.3, 1.4 at year end. So my understanding is that you are promising to return all of that to shareholders. Is that correct, or do you tend to keep some of that for M&A? And I guess just a related question, why not do more than 300 million initially? And then the final question is on profitability and cost income. I guess historically it seems somewhat challenging to improve your cost income ratio beyond perhaps the low 50s, which is obviously mid-50s is still market leading, but given the need to invest for growth, but with cost income ratio now in the mid-50s, how should we think about the marginal cost income ratio over and above your targets, assuming there is some market appreciation and what have you? Thank you.
Okay, I'm going to let Nicolas answer, but I would like to make one point as an introduction. The figures we give you today, we are committing on them, and we are very confident that we will reach them. But take the €7 as a floor, take the 57% as a cap, and wait, okay, do you want to change anything?
56?
I said 57? Sorry, my mistake. 56, I'm not changing the figures now. 56 is the cap. And you can be sure that whatever happens, whatever the scenario, we will commit on that. And we will deliver that. Nicolas, you would...
Not much to add on these 2 points, on the €7 and the 56%. They are
sorry for that.
a minimum for one of them and a maximum for the other. And let's not mix them. But maybe to complement on your question regarding the growth trajectory excluding UniCredit, what we believe, and that's consistent we have done in the past, and what we will deliver, we are confident we deliver, is to deliver an underlying organic growth of 5% in average per year. and it will be in the next years complemented by the positive impact of the acquisition of the stake and the partnership more globally with ICG and by the share buyback. And your second question on capital return and the share buyback, we cannot give a precise number for main reason is that first we have to build the position and build the stake in ICG. It's starting, so we don't know at what will be the exact value. But that's why we are committing for the share buyback to be at least 300 million euros, and we talk to you more when we announce the result in February to give you a precise number for the share buyback.
So once again, 300 million is the floor.
Is the floor.
Okay, Hubert, Bank of America.
Great, thanks. It's Hubert Lam from Bank of America. I've got three questions. Firstly, on the flows of 300 billion, how should we think about fee margin there? Just wondering if it should be accretive or not to the existing fee margin base you have starting off. Second question is on, go back to the cost-income ratio. I know the 56% is the top, the cap, the max. I know you're using that number to protect yourself against the UniCredit outflows, but if you exclude UniCredit, how should we think about cost-income? Because previously you're guided for 53% or lower. Is that still kind of the guidance, or do you think you can do better without excluding UniCredit outflows? And lastly, on, again, UniCredit, I think recently your tone has changed around the relationship. Now you're thinking more openly about them exiting in 2027. Just wondering where we are in terms of your discussions with them. Is the negotiation changed? And because previously you talked about how beneficial the relationship was in terms of you providing them with services and how value add you have. But just wondering if that has changed, or it's just their demands are just a little bit more extreme now than before.
No. I mean, nothing has changed in our daily relationship. We are completely and fully committed to. I'm looking at Cinzia here, who's in charge of the group. We are absolutely fully committed to go on servicing UniCredit networks and UniCredit clients at the highest level of service. What I can tell you is that what we told you for months and years is that our partnership with UniCredit runs until July 2027. It may or may not be renewed under conditions that we honestly don't know as of today. As this date is in the middle of our plan, it was obvious for us that we have to commit on figures that we can really commit on. And this is a part on which, for the time being, we don't know. So that was the idea of committing on these figures, which are, you understood, a floor. But nothing has changed in our daily and real life with UniCredit. And we will go on being committed until 27 and hopefully after that date.
Regarding your first question on the fee margin on the flows, we don't have a target and an objective in terms of blended margin. We know that margins are under pressure in our industry. It's not new. It has been the case in the past. It will continue. Nothing specific to Amundi. And the average margin going forward at Amundi will depend on the various pace of growth of our various businesses. But what we know is that, and what we commit on, is that there will be growth. This growth will be profitable, and they will result in the objectives that we just gave you today. Regarding the cost-income ratio and the impact of UniCredit, as you know, Amundi is an integrated company. We work globally, so we have limited cost associated to a specific client, whether UniCredit or any other one. But what we can say is we'll continuously work on our efficiency. And in addition, I can also confirm that excluding UniCredit revenues, there will be a positive jaws effect, meaning revenues growing faster than cost.
Okay, next question from Arnaud, BNP Paribas.
Good afternoon. I've got three questions, please. If I can start with intermediate capital, I was wondering if you could give a bit more detail on the financials. So there's, I assume, a revenue share with intermediate capital on these new evergreen products. I was wondering if you could give us an idea of how that split might look like, if any. My second question is with regard to Société Générale. Clearly, it's quite a small contribution to your revenue, so whatever the outcome has limited impact on your earnings. I was just wondering if you could give a bit more detail on the conditions of that renewal. Did you see a step down in the revenue margin? Did you see a change in the obligation for them to sell your products, or do they have more flexibility in open architecture? And my third question is with regards to SBI, IPO of that business. You've talked, quite a lot of Asia and the opportunities there. I assume there's no intention to sell down. This is just you participating in the IPO. I might be putting words in your mouth, but I'd like to hear it from you. Thank you.
Okay, so the first one is on ICG deal. We are not, this deal, as you understood, is really win-win. We're gonna be able to deliver to our wealth clients strong expertise with fantastic track records and with an exclusivity on all their products which are evergreen as of today. So mostly direct lending and secondaries. I'm not going to go into the details of the agreement. What I can tell you is that there will be strong synergies of revenues, and we are very confident today to tell you that we are certain that the return on investment will be above 10% in the next 3 years. But we have a lot of things to build between now and the next 3 years. But once again, very comfortable and very confident. Société Générale, the principle of the agreements are the same, similar to the previous one. The renegotiation has a marginal effect on our revenues. If you remember it well, we are the main provider of investment solutions for Société Générale wealth clients, and we will remain them. We are the sole partner for the management of the insurance mandate of Société Générale, and we will remain the sole partner. Société Générale is actually our partner for employee savings in France. And we use Société Générale Securities Services as one of our primary provider in terms of custody. So nothing has changed on all these fronts. So once again, the principles of the new agreement are similar, and the renegotiation has a marginal impact on our revenues. Last but not least, SBI. We are very happy. You may have heard about it in 2021. This was already a project. Because of the COVID, we had to postpone this project together with SBI. We are very happy to see this fantastic joint venture that we make grow for 20 years now, being listed on the market. Of course, it will unlock the value of this company, and this is obviously good. I'm sure that you will look at it, and it will help the company to grow in the future. But we are listing only 10% of the company today, which is great because we want to go on participating to the growth of this fantastic company, thanks to the growth of India, as simply as that.
Okay. A good illustration of that is that the 10% we are listing will be brought by the two partners in a proportion of their today's stake in 3.7 for us,
7%
and 6.3 from SBI.
We will take our next question from the online participants. Angeliki, I'm opening your mic. I think you can start speaking now and ask your questions.
Yes, good afternoon. Thank you so much for taking my questions. Just four for me, please. First of all, Can you split the 100 billion cumulative net flows from retirement into flows you expect to see in retail versus the institutional channel? And perhaps if you can also tell us within retail how much of that would be passive. Then another question with regards to the 150 billion net flows that you expect to collect in Asia. How much of that do you expect to come from joint ventures over the next 3 years? With regards to third-party retail distributor, the third-party retail distributor channel, can you also give us perhaps an indication of the flows that you expect to see over the period 2025-2028 there? It has obviously been a very strong lever for your growth between 2021 and 2025. So I just wanted to understand what sort of flows the third-party retail channel could contribute in the new plan. And last but not least, with regards to the evergreen partnership with ICG, can you give us some color on the distribution channels where those two evergreen funds will be distributed when they launch next year, please? Thank you very much.
Last question was?
Which distribution channels the evergreen funds with ICG would be distributed to?
Okay. I'll take the question. I'll start with the question on ICG, and I will answer on the figures if we have an answer. Probably not for all of them. On ICG, the idea is to do several things. The first one, it's not answering your question on the wealth side, but it's on the institutional side. We have already an agreement with Crédit Agricole Assurance, who, as you know, is a huge insurance company, the largest in France, to invest in their direct lending expertise over the next 5 years. So this is going to be, I would say, the first and already discussed transaction, and they will invest through Amundi, of course. Second, on the wealth side, we will as well first use what they have on the shelf, so the evergreen products, and we will distribute them to all the networks we work with. So I remind you, we have 600 distributors around the world. So a lot of clients we can go and see and propose the evergreen products of ICG. And we have an exclusivity on these ones. This includes, of course, our own group retail networks. As I was mentioning in my introductory speech, the private banks of Crédit Agricole Group and all the wealth client segments of Crédit Agricole Group as well, but also the 600 other clients with which we work worldwide. Then we have the project to build together new solutions, probably blended solutions, thanks to Vincent's team. Especially in the retirement area, where we will have solutions which are both liquid, but including a part of an illiquid expertise. So all these projects are coming in the next few months. And of course, we will put them on the market step by step. And once again, propose them to the clients who are interested.
As far as the questions around flows are concerned, of course, I cannot provide it's very, very detailed because it will go forward during the next year. What I can say is that we are expecting to have 100 billion in retirement. It will be both through retail and institutional channels. It will be in Europe and Asia, probably more in Europe than in Asia, but on both continents.
We can say that we plan 75
in Europe and the rest in Asia. As far as the Asian, the objective, as far as the flows in Asia, 150 billion, it will be, as in the past, both coming from our joint ventures and from our, I would say, direct presence in Hong Kong, Taiwan, Singapore, Malaysia, Taiwan, and I'm forgetting many of them, but more will probably come. And third-party distribution will grow as well. At the end of the day, what is important is on all these growth levers, we plan to have 300 billion inflows globally during this plan, and it's coming from these various levers. And of course, maybe I should specify that this 300 billion is without double counting, meaning that if we have inflows with a retirement client in Asia on passive management, it won't count 3 times, but only one.
Once.
Okay. Do we have other questions? None online, I think. In the room, maybe? Yes. One question. Sharat, Deutsche Bank.
Thank you. Thank you for taking questions. I have 3. Firstly, sorry to come back on the buyback. Interested in knowing the comparison of ROI, return on investment on buybacks versus those on M&A. And you said 300 million is the minimum. So what I want to understand is, are you open to using the entire excess capital X ICG for buybacks? Is there a regulatory constraint for that? That's the first one. The second is on Italy. Again, assuming that the UniCredit distribution does not get renewed in 2027, so what options are available to make up for this loss? Are you open to stepping up distribution through Banco BPM? Is a minority stake purchase in Anima? Are you open to doing it? Can you elaborate on options such as those? And final one is on India. My understanding is that listing rules in India entail a 25% free float within 5 years. Can you clarify? So how should we expect the stake sales in India, other than the 3.7% stake that you would sell next year? Last one related to that, I compute a capital gain of around 300 million from the 3.7% stake that you would sell in India, assuming a $12 billion IPO valuation. So what would be the uses of it? Thank you.
Alors, I will answer the first part of India. You're right about the rules to reach 25%, but it can be either in 5 years or in 10 years according to the size of the IPO. We believe, to be confirmed, that the size of our IPO will let us 10 years to reach this 25%. And we will do it step by step, very, I would say, taking the whole length once again to make sure we go on benefiting from the as much as possible from the growth of this company. On Italy. One thing I would like to remind, we manage today more than 200 billion, 210 if I'm right, for Italian clients. Only 1/3 of these 210 billion are managed for UniCredit, and we are working in Italy for more than 200 clients. So we are already working today in Italy with nearly all distributors and a huge number of institutional clients, from the smallest to the largest Italian clients. So Italy, whatever happens and whatever the scenario, is and remain a strategic country for us, and will go on growing for sure. And I forgot the first question, which was on?
Share buyback.
Share buyback, for you.
So I think the first question was a comparative return of share buyback versus M&A. Historically, we have made acquisition with a very significant return on investment, above 10%. For example, the last ones were more around 12%. So I think when we find this kind of acquisition, it makes a lot of sense in the interest of shareholders to do M&A. And your second question was regarding the coming share buyback. Yes, we intend to return the excess capital after the transaction of ICG. But of course, we have to take the regulatory constraint coming from our from a solvency requirement, with probably a small buffer for security, but the intention is to distribute what is available.
I think Jacques-Henri had a pressing...
That was on SBI.
Okay. Another question by Nick, Citigroup.
Hello again. I guess ICG is well renowned as being an asset manager, a very high quality asset manager for institutional investors, managing closed-end funds. Its move into semi-liquid strategies is much more recent. I guess catering to the many wealth clients that your network will clearly provide access to will also provide an additional level of require an additional level of operational sophistication. So I guess is there also room for you to kind of provide your Alto solutions, your technology solutions to ICG to facilitate that process? I guess also consistent with how thinking about how BlackRock is using Aladdin with Partners Group as part of its own joint solution. Thank you.
That's a very good question. Very concretely, the structure will be managed within Amundi. So by definition, we will use Alto. ICG is perfectly managing their expertise, their portfolio. The same portfolio managers will manage the expertise that we will onboard and structure under a retail format to be able to distribute them to our wealth clients. So we will take within Amundi the structuration process of all wealth solutions that we will distribute from ICG.
We actually have one question from the Zoom webinar. Johan Scholz, you can open your mic now.
Thanks for the opportunity. Two questions from my side. Maybe a bit more taking a high-level view. What's your thinking in terms of your competitive advantage relative to your large US competitors in the passive/ETF space? It's a space that's becoming more concentrated, as you well know, and what do you think is the longer-term outlook there? And then secondly, with the rapid expansion that we are seeing in digital distribution on the wealth side, what's been your experience in terms of longevity, client churn there? And, I would assume, it's a space that can be potentially subject to quite a bit of churn. What measures can you take to increase persistency? Thanks.
Any answer to the second question? On the first one, we have the same advantages on the ETF space than on any other space compared to our global American competitors. The first one is that we are European, and a number of our clients, whether in Europe or in Asia, want to have a very large global leading European asset manager. They want to have our views. They want to have their money in Europe, so they choose us because we are European. Second, in terms of, I would say that the second big advantage we have, competitive advantage we have today, and once again only on the ETF space, but globally, is the fact that we are very invested in sustainable finance. We have always been, we will always be one very responsible asset manager, and this is one of the reasons why we are today winning a lot of mandates against our American competitors. Fanny, you want to answer on the Well spot?
Well, digital distribution, as we disclosed into our capital markets in June, actually is a booming industry. You obviously have some neo-brokers, but you have more and more actors focusing on the longer term on the value chain, notably focusing on savings, on retirement, offering monthly auto-enrollment schemes, which makes it accretive, as you might have heard from our retirement and also from our wealth introduction. I mean, we've got many stakes in Europe to save for retirement, to develop as well some ecosystems, and digitalization is enabling some financial inclusion and thus actually having more actors to participate into long-term savings. So all in all, yes, there is a bit of trading account on one side, but the vast majority is for savings and long-term.
Okay, I think we have a question from Benoit from Odo.
Yes, good afternoon. Thank you for taking my question. Few questions on my side. Maybe the first one, coming back on ICG. I can understand that it will generate a lot of revenue synergies and your investment will achieve your profitability target, but did you really need to buy this stake of almost 10% on ICG to cement this partnership, or will you have been able to make this partnership without this investment? The second question is regarding maybe cumulative excess capital generation over the next plan. There could be some earn-out on recent acquisition. So what is your expectation in terms of excess capital generation over the next 3 years? I have a small technical question, I'm sorry, regarding your minimum €7 EPS figures for 28. You are assuming a tax rate similar to 24, but there has been an extra tax charge of our French corporate on 25, which apply also on 24 earnings. So just technically to understand if this is taken or not into account on your EPS minimum target. And maybe last question, if I may, you did not comment so much on ESG fund and ESG, which was a growth driver for the group over the last plan. So I don't know if you can elaborate a little bit on that. Thank you.
Sure. I will take the first and the last question and let you the two others, Nicolas. On the ESG, as I was just mentioning, it's a huge competitive advantage for us. We have not changed anything. We will not change anything. No? So in our plan, I think I explained in my speech, we commit on having, today we have 280 billion euros under management in net zero solutions all over the world. When we receive RFPs from our European clients, 90% of them are including at least one criteria related to responsible investment. We commit to keep the largest worldwide investment solution range of products. We are working, I'm looking at Jean-Jacques, on blended finance solutions. We are working on climate solutions again, of course. We are working on biodiversity, which is a nascent topic, but more and more our clients are requesting us to work on it, and we have, as you know, very strong research team on all these topics. So you can be sure, and we are as well, I should have said, we have a very strong stewardship team, which is recognized from our clients and very much used. So we do not change anything, not only because it is in our DNA, but also because we are convinced and very confident that it will bring more growth in the future. On ICG, we could have discussed a partnership without investing in ICG. We have a very strong common DNA. We have discussed for a long time, so we know each other very well. We are incredibly focused on performance and clients' interest on both sides. That's what is important for us. So we could, but we felt that it was really important to cement this long-term partnership, 10 years partnership, through this participation. And we're really thrilled to have been able to announce it this morning.
Regarding the question on capital regeneration, So as I was mentioning, we are listed as a credit institution, but our activity organically generates very little new capital requirement. So basically, going forward, we can rebuild a strong capital position. Basically, almost all of the annual results that are not distributed contribute to building our capital position going forward. And your third question was about taxation, if I remember well. You know, there's a budget debate, but we are in the middle of it. We don't know where it will go, so it's too early to say what impact it may have.
Thank you. We have the next question from the webinar. Again, a follow-up question from Angeliki. Angeliki, I think you can open your mic.
Yes, thank you for taking my follow-up question. Just a clarification on the EPS floor, as you called it, of the €7, which includes all potential scenarios on UniCredit. I just wanted to understand, does that assume that in 2028 there are zero revenues from UniCredit under the worst-case scenario, or realistically, you know, if we were to just look at the partnership, it ends in the middle of 2027. So even if they wanted to not continue, there would still be some AUM in runoff. I'm just effectively trying to understand if there's zero contribution from UniCredit in that floor, or if there is still some perhaps in 2028. And then do you have a buyback assumption within the floor of the €7? And is that the minimum of 300? Thank you.
So we do have a share buyback assumption, the one we will be doing next year. And regarding the first part of the question, it's really in all UniCredit scenarios. So even a scenario where there's almost no AUM left in 2028.
Okay, there's a follow-up question from Arnaud, BNP Paribas.
I've got a quick follow-up on Angeliki's question, actually. So all scenarios include minimal or no revenues from UniCredit. In that scenario, how much costs are you taking out? Or if you can give us a framework to think about it, that could be quite helpful. And I just wanted to follow up as well on any tax implications. How should we think about capital gains tax from the sale of the Indian stake? Or the IPO and tax implications. Thanks.
On the cost side, I think that Nicolas already answered. Once again, our commitment today is really to a cost-income ratio below 56%, and the other commitment we have is to have a positive jaw effect, excluding UniCredit. We will manage our cost as we always did, and I think you can give us credit for that, following us for a long time, step by step, according to what's going on, and balancing cleverly things between our investment and our cost efficiency.
And regarding tax on capital gain or whatever, you are referring to income tax or?
When Amundi sold their stake, there was a meaningful capital gains tax, and part of it was through a Mauritius holding, and there was a very different tax rate. I'm just wondering how.
Had time to understand.
Sorry, it's
potentially there's quite a substantial capital gains tax implication from the sale from the IPO. So I'm just wondering what that can be.
From the IPO.
Yes, from the IPO of the Indian stake.
There will be withdrawing tax in India, and I think it's around 14%.
Thank you.
14%. And there's no double taxation between India and France. Yeah. So we are not taxed again in France. Any other question from either the room? Nothing from the webinar? No? Okay. I think that ends the Q&A session and our Capital Markets Day. So thank you very much for attending. It's been a pleasure having you. And obviously, the whole financial communication team is available if you have any follow-up question. digesting the 80 slides of this presentation and any additional remark that you might have. We would be very pleased to have any feedback from the way we organized and the way this thing has been dealt with and with the targets. So thank you very much again, and hoping to see you soon.
Thank you.